April 2, 2025, a seismic shift hit U.S. trade policy, one that, well, will likely be studied in economics courses for decades. That day, defying warnings from economists, traders, and even his own political allies, Donald Trump pushed through a sweeping set of new tariffs. The official explanation? According to the administration, America has long been the victim of unfair trade practices, with countries manipulating currencies and imposing hidden barriers to exploit U.S. prosperity. In their view, the time for leniency was over. But their approach raised more than a few eyebrows. For example, among the supposed currency manipulators was Ecuador, a country that, well, uses the US dollar as its sole currency. The logic? Thin at best. The methodology behind these tariffs wasn't drawn from rigorous economic analysis, but seemed more like a back-of-the-napkin calculation. Trump's team reportedly measured trade imbalances, and based on a simple formula, claimed that if a nation enjoyed a 40% trade surplus with the US, it was clearly gaming the system. The response? A tariff worth half that, 20%. That's not satire, that's the actual policy. When that formula leaked, the backlash was, well, swift. The White House denied it, claiming instead that the policy was rooted in sophisticated economic modeling. Yet behind the curtain, those models reportedly amounted to multiplying trade deficits by hand-picked variables with no real-world grounding. To make things worse, even countries that import more than they export to the US weren't spared. A blanket tariff of 10% was slapped on some of them, regardless of whether they shipped much of anything at all. Legend has it that one island was taxed despite exporting nothing but postcards and penguins. Trump named the day Liberation Day. Ironic, considering the US already celebrates independence every 4th of July, a date that, historically, represented a fight for free trade against the British Crown's restrictions. But Trump's tariffs weren't just symbolic. They marked a break from nearly a century of US policy. Since World War II, the United States has championed open markets. Even during the most protectionist eras, average tariff levels rarely exceeded 20%. This new policy? It could push that average to over 30%. When Trump took office, America's economy was booming, outpacing most developed nations. Growth was fast and steady, almost rivaling emerging markets. But now, we're seeing forecasts of economic contraction. The Atlanta Fed expects the economy to shrink by 1% this coming quarter. While some analysts remain hopeful, financial markets have entered panic mode. This isn't the first time tariff fever has swept through Washington. To truly understand the magnitude of what's happening today, we need to look back nearly a century, specifically to the early 1930s, when the United States made a decision that would ripple across the globe with devastating consequences. That decision was the passage of the Hawley-Smoot Tariff Act, one of the most infamous pieces of economic legislation in U.S. history. On paper, Hawley-Smoot was meant to be a lifeline. The country was reeling from a stock market crash, farms were failing, factories were laying off workers, and political leaders were desperate to show action. The logic was simple. By raising tariffs on imported goods, the government hoped to shield domestic industries and agriculture from foreign competition, thereby creating jobs and stabilizing prices. But the road to economic ruin is often paved with good intentions, and this was no exception. The bill imposed tariffs on over 3,000 goods, making it one of the most extensive tariff laws ever passed. It was crafted after exhaustive consultations. Over 1,000 business leaders and industry representatives were interviewed, culminating in a 10,000-page report. At first glance, this may seem like a carefully calibrated policy effort, but it quickly became clear that the law's complexity was part of the problem. It wasn't crafted by economists with a long-term strategy, but by politicians responding to pressure from special interest groups. Each industry lobbied for protection, and Congress delivered, sometimes arbitrarily. The timing couldn't have been worse. Global trade was already slowing due to financial instability, and Hawley-Smoot acted like a torch in a dry forest. International partners, outraged by the sudden spike in U.S. tariffs, retaliated almost immediately. Canada, one of America's closest trading partners, imposed its own steep tariffs on U.S. goods. European countries followed suit, and soon, what had started as a protectionist policy at home, triggered a trade war that spiraled out of control. One of the most destructive elements of the law lay in how the tariffs were structured. Many were based on fixed per-unit charges, not percentages. That means they didn't adjust when the price of goods fell. For example, a 2.5-cent duty on a pound of sugar doesn't sound too bad, until the price of sugar crashes. Suddenly, that tiny duty represents a huge slice of the total cost. In the midst of the Depression, as deflation took hold and prices nosedived, these fixed tariffs grew heavier and more punitive by the day. The result? Imports collapsed, trade dried up. According to some estimates, US imports declined by nearly 40% in just a few years. While economists agree that Hawley-Smoot was directly responsible for about 10% of that drop, the psychological and diplomatic fallout was far greater. The message was loud and clear: America was turning inward. But perhaps the most catastrophic impact of Hawley-Smoot wasn't measured in percentages or dollar losses, it was in what it symbolized. It undermined global trust. Countries that once saw the United States as a leader in economic cooperation now saw it as a threat. And as walls went up, international relations deteriorated. Trade partners stopped negotiating and started retaliating. Opportunities to foster collaboration vanished. In some cases, entire markets were lost for years. It's important to remember that the world in the 1930s was already in a fragile state. The Great War had ended barely a decade earlier, and the global economy was still rebuilding. The moment demanded unity, not division. Instead, protectionism fractured what little stability remained. Now, nearly a century later, we find ourselves at a crossroads once again. The question looms large. Are we witnessing a repeat of Hawley-Smoot in modern form? Could today's aggressive trade policies set off a similar global backlash, one that starts with tariffs and ends in economic isolation? Back then, President Calvin Coolidge had chosen to ignore the cries of American farmers, many of whom had borrowed heavily during World War I and were now drowning in debt. His hands-off small government stance left them behind as Europe recovered and stopped buying American crops. Herbert Hoover, his successor, tried to fix the damage by promising protection through tariffs. But what started as a campaign pledge quickly turned into a legislative Pandora's box, unleashing forces no one could control. And while Hoover's approach may have been more methodical than today's executive directives, the end result was the same: chaos. That's why economists and historians alike raise the alarm whenever large-scale tariffs re-enter the conversation. You see, what history teaches us is that trade wars don't just hurt wallets, they unravel systems. They erode relationships, stifle innovation, and ignite political instability. And honestly, by the time the damage becomes visible, it's often too late to reverse course. So as we look at the tariff-heavy policies of today, we really have to ask ourselves, what lesson did we truly learn from the past? Trade isn't just about numbers, it's about relationships, trust, and shared prosperity. When the United States raised barriers in the 1930s, retaliation came swiftly. Canada imposed its own tariffs. European allies backed away. Cuba walked. Even the political landscape in Germany shifted. Rising tensions and economic desperation helped pave the way for extremist ideologies. And now, the script feels eerily familiar. China has announced retaliatory tariffs of up to 34% on American goods. The European Union and Canada have voiced strong opposition. Mexico is reconsidering trade deals. Trust is fraying. Economist Charles Kindleberger described the collapse of global trade from 1929 to 1933 as a spiral, from $3 billion in monthly trade down to $1 billion. And that collapse didn't just hurt wallets, it destabilized the world. Today, similar dangers loom. Trade barriers may feel like a patriotic defense, but they can suffocate innovation, isolate allies, and spark geopolitical tensions. As the saying goes, where goods stop crossing borders, soldiers might start. The future of global trade now hangs in the balance, and the road ahead forks into four distinct, yet deeply uncertain paths. Global concession. In this scenario, the world submits to the pressure. Countries, despite their grievances, agree to renegotiate trade deals on terms heavily tilted in America's favor, essentially validating the aggressive tariff strategy. The outcome? A new era of US-dominated trade policy, driven more by coercion than cooperation. But even if this path leads to short-term economic benefits for the United States, it comes at the cost of long-term trust. Allies may comply, but they won't forget the strong-arm tactics. And the seeds of resentment could sow instability down the road. US retreats. Here, the pressure from within becomes too great to ignore. With economic growth stalling, markets faltering, and key sectors beginning to suffer, Domestic pushback intensifies. Under mounting political and financial strain, the United States begins to roll back some of the harsher tariff measures, signaling a return to diplomacy. While this is arguably the most stable path, it's also the least likely, especially if national pride or political calculation outweighs pragmatism. Historically, leaders rarely retreat from bold economic moves without significant internal cost, a new world order. Rather than waiting for Washington to back down, other nations pivot. The European Union, China, India, Japan, South Korea, and others begin to build stronger trade networks among themselves, sidestepping the United States entirely. Regional trade pacts and new economic alliances form, effectively isolating America from the global supply chain it once helped create. While the United States might still thrive in certain sectors, its influence would erode, and the economic world map could be redrawn without it at the center. This path reshapes the global economy, potentially permanently. Global breakdown, the most dangerous path of all. If tit-for-tat tariffs spiral out of control, global trade could fracture under the weight of nationalism and protectionism. Supply chains collapse, inflation spikes, and recession looms not just in one nation, but across many. This economic fragmentation could ignite political tensions, accelerate instability in already vulnerable regions, and lead to the kind of ideological polarization the world hasn't seen since the interwar period. As the old adage warns, where goods stop crossing borders, soldiers might start. There are differences between now and the 1930s. For one, the gold standard no longer exists. Countries can now let their currencies float, which acts as a shock absorber. In theory, a country hit by tariffs can offset the damage with currency adjustments. But theory doesn't always align with reality. Trump's tariffs should have strengthened the dollar, but instead they've sparked uncertainty. Investors hate unpredictability, and markets are reflecting that fear. What happens next? It depends on how leaders respond and how nations adapt. But one thing's for sure, ignoring the lessons of history could prove very expensive.